Hello, chart watchers and Decision Point faithful. Welcome to this Monday, November 4th, 2019 edition of Decision Point with your hosts, Carl and Erin Swenlin. For those of you joining us for the first time today, we welcome you to the show and we hope you come back. And of course, for our regulars, welcome back. All right. It's been a pretty interesting week in the market, hasn't it, Dad?
Yes, it has. And it's kind of hard to figure it out, but we'll do our best.
Absolutely. That's the best we can do. So today we're gonna, it's gonna be kind of a special show, I guess. We're gonna start off kind of how we usually do. We'll look at the broad markets and the DP scoreboard. I'm gonna go over the DP indicators. I wrote specifically about the Swenlin Trading Oscillators on Friday for the Chart Watchers articles, the Chart Watchers newsletter. So I recommend you take a look at that, but I'll give you a brief recount of what I did for that article because I think it's important and needs to be looked at, especially since it's updated today. For our bonus, what we're going to talk about today are ETFs, and we're going to talk specifically about some indexed ETFs. And Carl has been looking, and we've been talking about it as well, about a passive investing bubble. And this has kind of been out there on the internet for of late. So I think it was really interesting when we started to look more closely at this possible building bubble. And so I think you're going to really enjoy that section on at the end of our show. So stick around for that. But it is going to be started off with our decision point scoreboards. And there's really no arguing that the trends are up. But at the same time, we are in that overbought territory, of course, while we continue to make these new all-time highs. What was interesting is last Friday, we did see those weekly PMOs, the price momentum oscillators. They all ended up with buy signals in the intermediate term on Friday. So when those charts went final Friday, that's when we check our weekly signals. And sure enough, we had those positive crossovers on those charts. And I'll give you a brief look at those as well. As far as our decision point sector scoreboard goes, everything is on a green light buy signal. Intermediate term trend model is the 20 and the 50-day EMA crossovers. So we had a positive crossover for all these buy signals here. Sell signal, the 20 dropped below the 50, but it did so while the 50 EMA was below the 200. So that's what gave us that sell signal. And then we have the long-term trend model buys that are all those 50s are above their 200-day EMAs. And the sell signal tells us that XLE is still in a bear market configuration with its 50-day EMA below its 200-day EMA. All right, so let's go ahead and I'm going to pull up some charts for us to look at. And we will go ahead and start, of course. We're going to look at I have some basic charts that I usually put at the beginning of my decision point alert midweek. And so I wanted to go over those briefly, but these are the Silver Cross Index and the Golden Cross Index for the S&P 500. This tells us how many of the components, the percentage, have their 20s above their 50-day EMAs. And the Golden Cross tells us how many components, the percentage, have their 50-day EMAs over their 200-day EMAs. And I am pleased to report that we've finally gotten to at least 2/3 of the S&P 500 having their 20s above their 50-day EMAs. It's been kind of crazy watching this move to the upside and all these new all-time highs being set and not seeing even 2/3 of the index participating per se, because their 20s were below their 50-day EMAs. All right, so quick look at those. Let's look at the relative charts of a broad market indexes to the S&P 500. Dow is performing pretty much on par with the S&P 500, so it is making new highs. We have the NASDAQ 100 also really pretty much performing in the same way that the S&P 500 is. I thought it was very interesting to see that the OEX, we are seeing those large cap stocks outperforming the S&P 500 currently. And I do like seeing this little move to the bump to the upside for the mid caps and the small caps, and seeing them start to somewhat outperform the S&P 500 right now.
That OEX
Mm-hmm.
relative strength, basically that's saying that participation is narrowing down to the large cap stocks. That's essentially what's going on there.
Right.
So it's higher relative strength because it's the large cap 20% of the S&P 500.
There you go. So that tells you who's leading the charge right now.
Right.
Broad market indexes in general, just a quick peek. As you can see, new all-time highs coming in for the S&P 500. It's not a new all-time high for the S&P 400 yet. That would be back here. And you can see the S&P 600 is still well below its all-time highs, not even really challenging that. But we are starting to see new highs for the year coming through. I could have lowered that just a little bit so you could see that breakout. And breakout for the Dow, of course. And well, there you go. The NASDAQ is also showing that breakout to the new all-time highs.
You know, something that has been overlooked, I think, is that we did have a cyclical bear market back at the end of 2018.
Mm-hmm.
I don't think that's been generally acknowledged. Am I off base there?
I don't think so. I would say.
But as far as not having been mentioned, because the S&P 500 didn't quite make it to 20%, which is the sort of unofficial
Calculation, right?
Yeah, to be a bear market, but all the other broad markets did go 20% or more down during that period. So
yeah,
just something to keep in mind.
Right, and really the mid caps and small caps really got hit especially hard, and they still aren't really recovering to the degree that I would have expected when you've got everybody else starting to participate, and we need them to get up there and start to really participate. But you know, they're still really so far below their all-time highs, especially the S&P 600. All righty, global markets, not much to really say about that chart, except that as you can see, we're starting to see the test of some of those all-time highs coming in, but we're not getting the breakout to new all-time highs, except for in the French CAC, and that really is the only one right now making the new all-time highs. Of course, the TSX had already done so back in September, and it hasn't come back up to test those all-time highs. And we are getting these breakouts now finally on these global indexes, but still well away from their all-time highs. All right, let's look at the S&P. And one of the things I noticed when I was looking at some of the other charts, and honestly, I think you can see it better on the SPY than you can with the S&P 500. But since that gap up back here in the beginning of September, we really are seeing sort of a parabolic rise into those new all-time highs, and we're just not seeing the support that we really want to see. And I say that because these Swenlin Trading Oscillators, these are short-term indicators, and as you can see, we've had these really nice nice upswing. We've seen this in the past, and then we have these negative divergences coming into play. And they typically happen before you get a big decline. And, you know, when you're looking at a parabolic rally to the upside, the last thing I would say that you would want to see are these Swenlin Trading Oscillators continuing to move lower. And, you know, even with the punch we had on Friday to the upside and today, these indicators are just not reacting as I would expect them to. And because they're not, that does have me concerned. And like I said, I wrote about it in Chart Watchers. I went through we have all of the Swenlin Trading Oscillators for most of the major indexes. And looks like these haven't quite updated yet, but you're going to see on all of these charts, you're still going to see those declining tops trend lines. Let's see, let's look at the NASDAQ 100 here. Same thing, still having that problem with that upside move. But like I said, you know, we don't have these updated, at least for these other indexes, but we did have it updated for the S&P, and we're not seeing what we need to see. So I am going to pass it. I'm not going to actually pass it completely back to you, Chad. But was there anything you wanted to add with some of the things we're seeing here on these oscillators?
No, not right now.
Okay. Yeah, I did note that when we were looking at those other charts, they had not updated. We do have the updated readings here for the S&P 500, and we did not get a profound move to the upside after what we're seeing right here, which is almost parabolic move. And
well, I know what I wanted to say. The parabolic, it is in the short term, so it's not a serious. You know, you don't expect a really huge down move, but it could reverse pretty quickly and catch people flat-footed, and so at least in the short term, it's kind of a dangerous situation.
Absolutely. And again, when it's not accompanied by confirmation with some of these indicators, certainly seems like shaky ground. Or what did you used to call it? Thin ice.
Right.
All right. So the second part of the program, we wanted to talk about this passive bubble that's coming, passive investing bubble. And I thought I would start off by just before Carl really digs into this, I just wanted to talk to those of you who maybe are a little bit more beginners and aren't really familiar with an exchange traded fund or an ETF. Basically, an ETF it's like a mutual fund. It holds multiple underlying assets similar to a mutual fund, but it trades like a stock. And typically, especially with the indexed funds we're going to talk about, typically they aren't managed like a mutual fund is. You know, everybody puts their money in to the mutual fund, and then the manager takes that and adjusts everything at the end of the day, and you get your net asset value, and he or she is prepared for the next trading day, and it's not the same. My understanding is there are some managed ETFs out there, but what we wanted to talk about in particular was the index funds. So a lot of people do this. A lot of inexperienced investors use ETFs. It's a popular choice because you are getting into something that's got a basket full of stocks. You maybe couldn't go out and buy every one of the S&P 500. So using the SPY instead is a way to reduce your risk to some degree because you own a great deal of underlying assets. So we're going to look mostly at these indexed ETFs, but there's also the inverse ETFs that track exactly opposite. Of course, there's the leveraged ones, which I highly recommend not getting involved with. Industry ETFs, so follows an industry group. Bonds and commodities. I mean, there's something just about for everybody. So I just wanted to give everybody kind of a quick background as to what ETFs are about so that they'll have a greater understanding when you take the screen here and talk to us a little bit about this passive investing bubble.
Okay, taking over. Okay. Indexing. We have the ETFs, which track various market indexes. That's the way they're designed. And but there's a huge amount of indexing going on with regular mutual funds. And the problem with it, this is something I first heard about probably 15 years ago from a friend of mine who's Alan Newman, who sponsored me for membership in the Market Technicians Association, now the CMT Association. But I was really happy when I saw SPY come out. That was one of the first, and it was great because you could participate in that index without having any single stock exposure. And the problem is when you buy an index fund, when you buy an ETF, an indexed ETF, you are forcing that manager to buy every stock in that index, weighted however they have them, but every stock gets attention on that. Whereas if you were using active investing on that same group of stocks, you would be going through them on a constant basis, rolling out of some and into others, and you wouldn't own all 500 stocks. You would own a percentage, maybe only half, maybe less than that. But so you would theoretically be able to do better than the index, although let's face it, there are a lot of people trying to do that and that don't have that great of performance. But the real issue is that when you're indexing, when it's passive, it takes all the cats, dogs, and pigs in that index and gives them attention that they don't deserve. So what brought this to my attention, actually, I was noodling around on the internet a couple of weeks ago, and I saw some articles and videos about Michael Burry, Burry. He was the individual in the movie The Big Short who figured out that there was a problem with mortgage-backed securities. He actually went and looked up all the mortgages that were in those securities, hundreds, maybe thousands, and found that there were a lot of them that were in default, and could see that there was a big problem, and he turned out to be right. His latest commentary or thing that he's focused on is the passive investing, the indexing issue, which is just what I explained, and that's where I started to pay attention, and I'm still chewing on this. It'll take me a while to come up with more angles to it, but it's mainly what happens when all these cats, dogs, and pigs, when it comes a down swoosh, what's going to happen to them? I mean, the fact is, all the stocks are going to be dumped at that time, whereas in an active investing, some of the better stocks would go down less. They would outperform the index by only going down, say, half or 3/4 of what the index did. So I got to thinking about it, and Erin and I were looking at this chart, and we're talking about the problem with the indexing, and I looked at this chart and I thought, oh my gosh, there's the bubble right there. Now maybe I'm wrong about that, but that's a beautiful manifestation of stocks that don't deserve attention getting attention. So you have the S&P 500, this red line, this red dotted line is where it would be if it were overvalued with a PE of 20. And I can't remember, it's about 23 now, something like that. So over the period of time, let's see, 1999 is when SPY came out, I think. And during that, I think that this passive bubble, index bubble, has been growing over time. And I think that's one of the reasons why this it's been so persistent, staying overvalued, above overvalued. Chip Anderson, president of StockCharts, once wrote something about the PE of 20 being the new normal or something like that. And in my mind, I objected to that, applying the word normal to it. But it actually think there's some basis in fact in that, because again, there's this bubble, and it seems to me that that's the reason the S&P 500 has been so overvalued for so long. So, did you have any comments or questions?
Yeah, I mean, you've pointed out well the dot-com bubble and how that's when you can see that we became overvalued, and it continued so, and it continued so until the bubble burst. I think it's interesting that it never really came all the way down to fair value.
It never got down into the normal ranging again.
No. And then there you go. While we started to finally get within that range, now we had the real estate bubble building.
Right. And that was interesting that it never got past the overvalue range at that point, the edge of the range. So that was interesting. Haven't figured necessarily what that means at this point, but when I was looking at this, that's suddenly your eyes open and you see something you hadn't seen before.
Absolutely. And then yes, right at about 2015, 2016, that's about the time where everything started to get out of whack again. And we finally had the pullback and everything, the secular bear market, but it didn't help.
Yeah, and these hash marks show where these are set there based on projections for 2020 second quarter. And right now, we're the stock market, S&P's above projected earnings now. It's above the projected range, which is really it's getting more extreme.
Right. And it tried, we had that secular bear market. I mean, it did try at the end of 2018 to get back into the range, but it was still not enough, really.
I had some other things here.
Yes.
Let's see. Okay. Here we've seen this chart before. Maybe some people may wonder why I keep SPY volume plus S&P 500 total volume. But here on a day like this is a perfect example. We didn't get a lot of volume on SPY, which might make you suspicious about this up move today. But we did get a decent volume. We got it was the average, equal or a little better than the 1-year average of volume. So just wanted to show that. Don't always have a opportunity to do that. The PMO, by the way, here we had a divergence against that top, but now it's actually broken out of this downtrend, and that's encouraging. Okay, this is another one I wanted to look at. Is the Bullish Percent Index for the 3 major indexes. Here we have this, except for the New York Stock Exchange, they're making new all-time highs. But here again, we have the lower tops line, and challenging that today, but it's still a problem in my mind. You have this making all-time highs. You should be up here in this area, not down here. The problem, and of course, if we were up there, then I would have a problem with it. Oh, it's overbought. But, but the thing is that it's just not, it doesn't have the power behind it. And you can see here, the NASDAQ BPI, it's broken out, but over this line, but I don't take that kind of a breakout as seriously as when you have a finite range. This range is 0 to 100, and it's not the same as a won't say infinite range, but the stock price, the index price, it doesn't really have a top or a bottom that you need to keep in mind. And today I saw Tom Bully's his articles, and I didn't read it, but it just caught my eye that he had Occidental Petroleum, which is one I remember from way back when I started. And I said, well, let me look at it. So it's got a nice breakout here. And of course, the PMO has a bottom above the signal line, which is encouraging. The problem, if you go look back here, you got a lot of these hooks, though. You've got pop and then it's down, pop and then it's down, pop up and then down. So what I like to do, I always like looking at the longer term. I'm going to go straight to the monthly because that makes the point best. You got this huge top and it's breaking down from that. So while we have a short-term possibilities of good things happening, it's definitely not.
That doesn't look solid.
No, it doesn't look at all.
No.
Let me go back. I noticed the yield right now, it says 7%. Well, actually, they cut their dividend by 75%. So I don't get this. No, they cut the dividend. That's up. Okay.
Yeah, you'll have to talk to Tom about that.
Yeah, I didn't read the article. I wasn't my intent to counter.
Oh, yeah.
So what he was saying.
He understands that whole earnings relationship better than just about anybody I know.
Yeah. Apple. I've seen this chart a few times, but here we go. We're going up in a parabolic move again, and this is really a lot faster to come than previous ones. But Apple is really just, to me, it's known for this kind of parabolic crash. Here we had a 63% down move from that, and another. Here we had a 45% down move, 32 only here. Here was a 40%. Now, this is last year. How did it drop 40%? Did anybody notice that? Yeah. I mean, but that's a huge down, and here is already back up. It's made it all up again. But it's, this is dangerous. This climbing straight up is just nuts.
It is crazy for sure. I just, we watch these all the time. And, I remember at the beginning or the end of last year, I did a thing on the FANG stocks and the crash that had occurred and what to expect. And I'll admit I did not expect a parabolic move to the upside.
Let me show you why I don't like log scale. You go to log scale, you don't see any of the parabolics.
That's true.
If you want to feel the emotions of the moves, you really need a linear chart.
All right. Well, we got to wrap it up. We have about 10 seconds. So I just, Carl and I thank you guys for joining us. Hope you'll come back next Monday. We do air at 5 p.m. Eastern. Have a great day and happy trading.